It is November 25th of 1986, a day before the shareholder meeting of a legendary company, Kaiser Steel. It was founded by American tycoon Henry Kaiser in 1941, who 10 years earlier built one of the most impressive projects of mankind, the Hoover Dam.
We are here to celebrate the completion of the greatest dam in the world.
After World War II, the steel company has gone on to become a corporate giant. But by the early 1970s, due to the increasing labor costs and the competition from China, Kaiser and the entire steel industry declined sharply. While the company is in terrible shape, the management team spends lavishly on themselves, including buying 3 corporate jets and mansions. By 1986, it becomes a target of a hostile takeover. Bruce Hendry, a tough corporator, aims to gain control over Kaiser Steel Corporation. He plans to dismantle the company and sell them for pieces before it declines even further. Hendry has gathered a team of shrewd business operators, ready to replace 6 out of 11 board seats at Kaiser. Tomorrow, a line will be drawn: the Kaiser's management team versus the corporate raiders. But ultimately, the decision lies in the hands of just one particular shareholder, Ned Johnson. By 1986, Fidelity reigns supreme on Wall Street, containing hundreds of mutual funds, with the largest one being the Fidelity Fund. It has $65 billion of assets, money entrusted by millions of middle-class Americans. But these Americans may not know, when they invest their money to Fidelity, they're giving out their voting power. And this voting power now belongs to one man, the CEO of Fidelity, Ned Johnson. It's the type of power that can alter the direction of corporate America. For a long time, mutual funds pledge that they will always remain neutral in corporate fights and always side with the majority of the rest of the shareholders. For most takeover battles, it's clear which side is more profitable. But for Kaiser, it's not very obvious who to back. For the first time, Ned Johnson is compelled to wield that power. But until the shareholder meeting happens, no one really knows which side is on: the incompetent and wasteful management team, or the barbarians at the gate. On the day of the shareholder meeting for Kaiser, Fidelity shocks everyone by firing the current management team. But it also rejects Hendry's plan. Instead, Fidelity decides to bring on a CEO of their own. Practically, Fidelity screwed them both and took over the company for itself. Although the battle for Kaiser is far from finished, Fidelity's active involvement in Kaiser's board has altered the company's fate forever. In the 19th century, railroads were the bloodlines for the American economy. It allowed the country to quickly rise up from the ashes of civil war and become an industrial superpower. Union Pacific is the second largest railroad company in America, so-called a duopoly.
Now here we are, Union Pacific, the strategic middle route, operating around 9,600 miles of road, We serve some of the best neighborhoods in the country.
But by the end of the 19th century, railroads had been overbuilt. To survive, Union Pacific tries to develop a new competitive edge. They plan to build the nation's first refrigerated train cars to transport produce from Southern California to the rest of the country. But before they could enact their grand plan, a disaster strikes. An earthquake in San Francisco causes a great destruction to railroad tracks in California, and also sends a shockwave to Wall Street, where the stock of Union Pacific is being traded. The stockholders lost millions in a single day. But there's one man who's made a fortune from this incident: Jesse Livermore. A week prior, as a stock trader, Livermore had been borrowing shares of Union Pacific stocks and immediately selling them in the market, a scheme called short selling. Jesse Livermore had a hunch that something unexplainable and awful was going to happen. To profit from the downfall of Union Pacific, he sells short as many shares as he could borrow, hoping to repurchase them at a lower price and pocket the difference. When the earthquake happens, Jesse Livermore nets $255,000 of profit, the equivalent of $7.5 million today, in just one trade. While no one knows how he predicted the collapse, Jesse Livermore goes on to become a stock trading legend. His story is later published in a book a decade later called Reminiscences of a Stock Operator. This book will inspire a generation of Americans to join the stock market boom in the Roaring '20s. One of these wannabe stock millionaires is a law student at Harvard, Edward Crosby Johnson. Benjamin Franklin, one of the founding members of America, has also accumulated a fortune by the time he passes on. In 1790, on his deathbed, Franklin plans to donate his fortune to charitable causes after he's gone. But he also knows the power of compounding interest. He calls upon a group of people, businessmen and lawyers in Boston, to invest and grow his money for at least a century before donating them. This trust becomes one of the earliest forms of mutual funds, and Boston becomes the hotbed for the mutual fund industry. Born in a wealthy family, Edward Crosby Johnson enrolls in Harvard Law School by following his family's tradition. But after reading about Jesse Livermore, Ed Johnson dreams of making a fortune by trading stocks. He then enrolls in Harvard Business School to learn about investing during the Roaring '20s.
But this was the first time that Joe on the street saw the stock market going up and decided, I'm going to go get myself a loan to buy stock. And by the way, I'm going to make a handsome profit doing it.
Day by day, we were nearer to the final triumph over poverty than ever before in the history of any land.
But just as Ed Johnson is about to quit his day job and jump into the stock market, the Great Depression has arrived.
And there must be an end to a conduct in banking and in business which too often has given to a sacred trust the likeness of callous and selfish wrongdoing.
There were many causes for the Great Depression, but one of the obvious ones were these investment trusts that swindle a lot of money from average Americans in order to gamble in the stock market, like the mutual funds.
At the time, these investment trusts are unregulated. They often borrow money in the bond market in order to speculate in stocks. They also don't need to report their holdings to the government and their investors. Many funds even become money laundering shadow banks that are owned by the mobsters. But after the Great Depression, all of that is about to change. The FDR administration swiftly passes many regulations to prevent Wall Street from stealing the taxpayers' money to speculate. It is perhaps the worst time to join Wall Street. But Ed Johnson decides to become a better investor, he needs to find himself a mentor. And through his family connection, he meets William Parker, the owner of one of the largest mutual funds at the time called Incorporated Investors. Started as an accountant, Johnson quickly climbs the ladder and becomes a chief financial officer. But on the side, he also starts managing money for wealthy friends and families in Boston. Although Ed Johnson's job is lucrative, he also wants to become his own boss. He decides to start searching for a small mutual fund that he can take over. The Fidelity Fund started right after the Great Depression by two stockbrokers in Boston with $44,000 in assets. They take advantage of the negative sentiment the investors feel towards mutual funds. They market their Fidelity Fund as a safe place that doesn't use any leverage or borrowed money to invest, and also has a more diversified strategy. In just 3 years, it grows its assets to $3.3 million. But then the Fidelity Fund becomes stagnated as the country is being distracted by the World War II. As an open-end fund where investors can buy and redeem their money at moment's notice, they struggle to find more buyers of their mutual fund. By the 1940s, Ed Johnson enjoys a successful career in finance with multiple sources of income, including 6 figures a year from salaries, dividends, and the management fees. But that is not enough. Ed Johnson dreams of owning his own fund. He realizes that Fidelity is an excellent target for a takeover and an opportunity to be his own boss. He plans to consolidate his assets and combine them with Fidelity. But he also has a more sinister plan to grow Fidelity.
At the time, Ed Johnson had a lot of jobs, and there was no such a thing as non-compete agreement.
While Johnson is still on the payroll of Incorporated Investors, he starts quietly stealing their business and sending it straight to Fidelity, the small mutual funds he just took over.
He used the company's resources like brokers and dealers to bring more business to Fidelity.
I deem this reply a full acceptance of the Potsdam Declaration, which specifies the unconditional surrender of Japan.
While World War II is over, Ed Johnson has also won a secret war of his own. For years, he's been quietly building his own company under his mentor's nose, a direct competition to his boss mutual fund. The timing is impeccable. After the war ended, America is about to enter a huge bull market, the 1950s. For Johnson, he realizes that in a bull market, the best way to get rich as a mutual fund manager is not by performing well, but by selling well.
Johnson was among the first to hire third-party professional salespeople to distribute the mutual fund to the public. That was the beginning of the boiler room culture, when salespeople were very persistent, aggressive, and intimidating.
But Johnson also rebrands the image of mutual funds from speculative gambling machines to a safe haven for the risk-averse American public. He does that by emphasizing diversification. By the end of the decade of the 1950s, Fidelity becomes a major force on Wall Street, managing over $400 million. And slowly, Ed Johnson's style of mutual funds become the industry standard. But that also means he's losing his competitive edge. To beat his rivals, Ed Johnson must find ways to outperform everyone else. Ed Johnson finds himself a protege, Jerry Tai, a Chinese man who will soon make Fidelity the most competitive mutual fund in the industry. America is rising. After World War II, the country experiences a period of growth like none has ever seen. The prosperity once again has come back to Wall Street. A company at the forefront of this roaring bull market is Fidelity, a mutual fund giant run by the Boston financier Edward Johnson. Through aggressive sales and marketing, Johnson has brought Fidelity from obscurity to prominence. But the competition is quickly catching up. His biggest competitor is Jack Dreyfus, an aggressive trader who has consistently outperformed the industry by investing in growth stocks. Johnson knows the rules of the game are about to change. He needs to come up with a new way to beat his rivals, and he finds just the man to do the job. He's going to use a new strategy that no mutual funds have tried: high-frequency trading with technical analysis.
Technical analysis is the analysis of stock prices, or maybe other speculative asset prices, by looking at charts of the prices and looking for patterns that suggest movements in prices. Technical analysis is a subtle art that can augment trading strategies.
What Tai did differently from other investors was that he focused on the short-term trading patterns. He also traded in higher frequencies, often going in and out of position within a day. That was before trading was computerized. Fidelity had to hire a lot of brokers in order to accommodate his trades.
It works. His fund starts creating about 20% profit a year for almost 5 years. Started with just $10 million, Jerry Tai Fidelity Capital attracts $100 million within 3 years, and then another $100 million a year later. With his success, it becomes apparent that Tai will see his mentor as the new boss at Fidelity. But Ed Johnson has a different plan. In an increasingly complex world, it is more important than ever to do independent thinking. Brilliant.org is a great place to learn the tools that sharpen one's ability to think. Subjects like logic, probability, and game theory will teach you entirely new ways to think about the world of finance. Charlie Munger calls them mental models. By learning different subjects, one develops multiple ways of thinking. For example, almost all great investors tend to be good poker players. With a casino probability course at Brilliant, you get to learn and practice how to make optimal decisions under uncertainty and imperfect knowledge. What makes Brilliant stand out from the rest is that it makes seemingly complex subjects very easy to learn. The courses are highly interactive, and it makes a learning process much more fun and effective. To get started for free, visit brilliant.org/Phineas or click the link in the description. The first 200 people will get a 20% off Brilliant's annual premium subscription. When Jerry Tai was running the Fidelity Capital Fund and raking hundreds of millions, Ed Johnson also started a second fund for his son, Ned Johnson. Growing up as an aristocratic child, Ned Johnson is more social than his father and able to communicate with people of all backgrounds and social classes. After graduating from Harvard, he joins Fidelity and starts running a growth fund set up by his father. Although his performance is excellent, he is outshined by his father's protege, Jerry Tai. By early 1970s, Edward Johnson is retiring. To the outside world, it seems that Jerry Tai, his beloved and overachieving student, is the ideal candidate to succeed him. But secretly, Ed Johnson has been planning for his son Ned to be his successor. For years, Jerry Tai has devoted his energy and talent to Fidelity, under the impression that he will one day become the CEO. But eventually, it becomes obvious to Tai that Fidelity never belongs to anyone but to the Johnson family. He resigns from the company and starts his own firm. With his exile, many Fidelity investors also jump ship, as they realize they could make more money by following Tai. It causes a significant loss of capital for Fidelity, But to the newly crowned CEO, Ned Johnson, a much worse situation is about to unfold. By the start of the 1970s, a terrible bear market has arrived. And this one is unlike anything in recent American history. An inflationary depression.
And Arthur Burns, chairman of the Fed, he did not do what a good central banker should do and raise rates to break the inflation. And by the time the 70s ended, it was a total mess.
The mutual fund industry collapses by almost a half, and Fidelity is bleeding money. Ned Johnson just became the CEO with a chip on his shoulder. He was never the ideal candidate for the job. And with the exodus of star investor Jerry Tsai and the raging bear market, Ned Johnson may lose everything his father has built for him. To save Fidelity, Johnson knows he cannot rely on his own talent as an investor, but to play his bets on younger talents.
In that particular bear market, no one was investing in stock mutual funds. In order to keep them alive, Johnson had to get into money market mutual fund business.
So a money market fund will generally invest in highly liquid cash instruments with very short maturities, and they're typically seen as one of the safest forms of investments you can make.
Tell you, the 74 market crash, Fidelity was in the red. Now, what if we hadn't had a huge money market fund that was making us money while we were losing our shirts?
While many of his competitors have given up on stock mutual funds, Ned Johnson believes that is still the future. He just needs to find someone as talented as Jerry Tsai. Peter Lynch had a tragic childhood when his father died from cancer when he was just 10 years old. Growing up without a father taught Lynch the importance of having financial freedom. To get there, he knows finance is the #1 industry to get into. After earning his MBA from Wharton Business School, Lynch was hired as a research analyst, specializing in steel and metals.
On the side, Lynch has built a high-performing stock portfolio. During the time when everyone was losing money, he was making money. So eventually, everyone at Fidelity was going to him for stock tips.
To Ned Johnson, Peter Lynch is exactly the type of talent needed to revive Fidelity's stock mutual funds. Without hesitation, he promotes Lynch as the head of their Magellan Fund.
If I describe Ned in one word, dynamic. He attracts good people. People want to come here. It's because of him. He's one of the greatest people to work for, ever.
Unlike Jerry Tsai, Peter Lynch couldn't care less about charts and short-term fluctuations of stocks. As a student of logic, he believes in a simple proposition.
You buy a company to grow. And if it's a textile company or it's an electronics company or a software company, you better understand what they do. And if they do well, the stock will do well, no matter what happens to the market.
But it's more nuanced than that. To win like Peter Lynch, one has to find companies that have the potential to do well and that are yet to be discovered by Wall Street. His way of investing requires a lot of legwork.
But it works. Over the next decade, Peter Lynch beats the market almost every single year, with an average return of almost 30% annually.
Since 1977, Lynch's Magellan Fund returned 2,470%, as compared to a return of little better than 500% in Standard & Poor's 500 stock index.
Hiring Peter Lynch has been a stroke of genius. Ned Johnson capitalizes on Peter Lynch's celebrity status by opening up more funds. For Johnson, Fidelity is a product company. Almost anything an investor wants, he will build it for them.
They got retirement funds, tax savings fund, technology funds, industry-specific funds. It's almost like they are Walmart for mutual funds.
But then by the start of 1990, Peter Lynch does the unthinkable.
Peter Lynch, former manager of Fidelity's Boston-based $13 billion Magellan Fund, surprised Wall Street in May 1990 by retiring at age 46.
The retirement of Lynch comes as a shock to everyone in finance. But it's especially inconvenient for Ned Johnson, as Lynch has been his biggest cash cow for nearly a decade. To make matters worse, in a span of 3 years, many Fidelity executives are indicted for junk bond-related schemes.
The allegation was very serious, but it's particularly bad for a mutual fund when investors can redeem their shares at moment's notice. So any stain on their reputation will cause them to make less money.
Ned Johnson is once again back against the wall. His company and his reputation are under threat. But he eventually realizes that to bring the company out of the scandal, one thing must be done. Peter Lynch must come out of retirement. In 1992, to help restore the public's faith in Fidelity, Peter Lynch returns to save the day. But he will no longer manage Magellan Fund. Instead, he will only be working 2 days a week as more or less a brand ambassador. Lynch's return quiets fears, and Fidelity slowly stabilizes. As the bull market returns in the early 90s, Fidelity is again taking full advantage. Although competitors like Vanguard are gaining prominence, Fidelity still manages to hold its own, all thanks to Ned Johnson's leadership.
Unlike his father, Ned Johnson is really an institution builder. His father was content for Fidelity to be a boutique investment firm, but Ned Johnson has transformed Fidelity into a global financial powerhouse.
While Fidelity doesn't act like a family business anymore, Ned Johnson and his family are still in total control of the empire. To ensure Fidelity always stays in the hands of the Johnsons, he starts grooming his children to take his place. Out of all of his kids, his oldest, Abigail Johnson, seemed to be the most unlikely candidate.
I certainly never knew that I would actually get to the position that I've gotten to now. I was always interested in the business. It was impossible not to learn about it between my grandfather and my father.
Abby is a great salesman like her father and an excellent communicator. But at the same time, she's also very controlling and secretive.
By 1994, Ned Johnson starts giving his voting shares to his children. But to Abby, it's a sign that her time has come.
At the time, Ned Johnson was very fuzzy about when to retire and who to succeed him. I think the power of being a CEO of Fidelity is very addictive. Ned Johnson doesn't want to retire until the very end.
Abby Johnson agonizes over the uncertainty until she decides to orchestrate a coup. In 2001, Abby Johnson decides to take a shot at the king. She secretly gathers the key stockholders of Fidelity in an attempt to remove her own father from the CEO position. But it was unsuccessful, as the board decides to support Ned Johnson, the man who practically built the Fidelity empire. But her actions also earn the respect of her father, as she demonstrates the ruthlessness that is required in a business. Ned Johnson remains in power for another 10 years, until finally, Abigail Johnson finally takes over the throne of the trillion-dollar empire. In 2022, Fidelity is still at the very top of the finance industry, with almost $8 trillion of assets. With it comes immense power to influence corporate America. But what makes Fidelity more powerful and potentially dangerous is the fact that it's still a private company. owned by just one family.
Back in 2018, when major financial institutions were very hesitant about cryptos, Fidelity already started a cryptocurrency fund. Do they care about cryptocurrency? No, they just want your money.
The essence of Wall Street doesn't change. With every new generation, they always come up with new ways to gather money, whether it is through mutual funds or the more modern index funds. Fidelity is the best at doing that.